Let's start with the Fed. And I have to say, in the quarterly outlook, that was a lot more diplomatic than Mohamed's personal views. And I want to start with Mohamed's personal views on the Fed earlier this week. Mohamed, this is what you said. The Fed delivered what I expected, but not what I think is needed for sustainable economic well-being. It should have stopped purchasing assets immediately and given a clearer signal on rate hikes. Mohamed, did you not get that signal this week?
We didn't get a clear signal, and I'll refer you back, John, to what you were saying today. We have seen a massive migration up in expectation for rate hikes. As you put it, the center of gravity is now 5. We have Bank of America at 7. People are all over the place. It's become a very volatile outlook for a key interest rate. So the Fed is not in control of the rate narrative. It is not in control of the inflation narrative. And now people are starting to price in a bunching together of 3 contractionary influences from the Fed at the same time. So that is worrisome, and that's what happened when you fall behind. And rather than try and catch up, the Fed basically fell further behind this week.
Robert, in the quarterly outlook that you released a couple of weeks back, I'll repeat it, you were a lot more diplomatic. I'll read that one out. The Fed has been left with a rather small window to deliver an orderly pivot away from its decade-long policy of massive and predictable liquidity injections. Failure to do so risks a policy mistake that would undermine both global growth and financial stability. It is no wonder some emerging markets have already started hiking interest rates. Robert, I want to get to the last piece about that in just a moment, because I think that's important for EM. Can we start with the first piece? As a firm, at the moment, when you sit around the table, what are you discounting from this Federal Reserve? Is it a 5 to 6 to 7? Where does balance sheet reduction fit into it? What are you looking for?
Yeah, I mean, I think a lot of the debate is, around the perimeter. But, what's really important is whether it's 5, 6, or 7. We're moving to a very markedly different environment, right? We're moving from a tailwind to a headwind. And therefore, the strategies that have worked in terms of not fighting the Fed over the last 5, 10 years won't necessarily work going forward. But, thus far, we have discounted an orderly situation, more orderly unwind, and that's because we haven't seen outflows. The difference might be if anything catalyzes outflows. Perhaps 7 versus 5 could do that, who knows?
What do you make of the fact that EM has got ahead of this in quite a big way when you look to places like Brazil with just monster interest rate hikes through 2021, Robert? Does that help their cause looking ahead this year and the year after?
Yeah, but I think if you go back 25 years, times where the emerging markets have been behind the Fed, I think this time they're ahead with a few exceptions, perhaps Turkey being the most renowned lately. But I think emerging markets have matured. They've learned they need to be ahead, and they have less policy flexibility than the United States has had.
Mohamed, I'll use a phrase that you've used in the past, absorption capacity. Do you think EM has a lot more of that this time around?
I do, for the reason John cited. They've moved earlier on policies, and they've got bigger financial cushions. Now, that's a general statement. The interesting thing is that the dispersion within that general statement is significant. But absolutely, EM has learned and has adjusted accordingly.
That D word is something that comes up in the outlook at Gramercy quite a lot, Robert, dispersion. I'm looking at the cross currents of divergent monetary policy. You're looking for a fully synchronized global recovery at some point, but not this year. You're pushing that out potentially to 23. Robert, what's your approach to that in this market, in EM, at the moment?
Yeah, I mean, I think most importantly, emerging markets is not a homogeneous asset class, and that you have to look at that dispersion, triage that dispersion, and do bottoms up and top down wherever you're investing. Just because you find a bottoms up situation that looks good, we've spent a lot of time, as you can see with the outlook, talking about the top down and institutionalizing the top down and making sure that we don't buy bad homes in good neighborhoods. But ultimately, it's about credit picking, and it's about a portfolio construct that we've talked about in the past, less than just kind of being in beta, and more about having a multi-asset dynamic approach that allows you to take advantage of the dispersion in emerging markets and to move as that dispersion and the impact of that dispersion moves with it.
Mohamed, we used to talk about the tourists in emerging markets. Robert there just said it's not a homogeneous situation. People in EM have been saying that for a long time. The outsiders that come into the market and leave pretty quickly have other ideas. Do you think we have matured in just the way we treat this asset class as maybe not a broad asset class?
So far, as Robert said earlier, we have not seen major outflows, and that's good news. In the past, when you would have volatility, next thing you know, the tourists head for the airport and you get major outflows from emerging markets. We have not seen that yet. In fact, what we've seen is price action move way ahead of flows. So that's good news. It gives relief to people who worry about the lack of sufficient residence relative to tourist capital. But let's wait. There's other elements playing here, including the ability to get liquidity. Liquidity is not as ample as it used to be, and we have now started a journey, a global liquidity journey. We know what we're leaving, John, massive, predictable liquidity injection. We're not sure what we're going to. So we are still early on in this process, and it's something that has to be managed really carefully with the sorts of things that Robert has been talking about.
Robert, I want to turn to you on that because I think this is a story, an area of emerging markets that you've started to own. Liquidity risk. A lot of people conflate credit risk with liquidity risk. It's the if I get paid versus the when I'll get paid. Robert, do you think that's important as you look across from DM to EM and you start to think a little bit more about liquidity, where people think it is and where it isn't?
Yeah, absolutely. And following up on Mohamed's comments on liquidity, I mean, again, it's gone from a tailwind to a headwind. And as he was speaking, what comes to mind for me is the technicals in the marketplace have changed so markedly in the last 5, 10, 15, 25 years. And what I mean by that is the asset class is so much larger. Take emerging market corporates, maybe 5 times larger. The size of the street, the banks are so fewer banks with a lot less balance sheet. So that means when there are outflows, there's no guarantee, there's no bid of last resort. We don't see that on the way up because there's always this notion of inelastic supply. There's always an issuer that's willing to issue. But when there's outflows, that's when the liquidity becomes an issue. So to your point or your question, that's where credit becomes really important. Illiquidity and dislocation will be mark-to-market risk, but one needs to be really careful. There's a lot of late cycle poor credit picking that's done that turns into credit issues. So we're highly focused on structured credit, collateral, things that will survive despite the liquidity, no use of leverage, because leverage doesn't give you the ability to weather the storm.
Robert, build on that just for a moment. You would often say the risk is where people think the safety is. Can you give me an actual example of that? In DM or emerging markets for that matter, can you give me a specific example of that?
Absolutely. I think when we speak with LPs and prospective LPs, they think of kind of a stepping stone or kind of how do you lean into emerging markets credit over time. And the safe place is considered to be liquid emerging market debt. And you know what? Might as well buy it in an ETF because it's tradable and it's liquid. I think it's anything but that. Just because the ETF is liquid doesn't mean the underlying portfolio is necessarily liquid. And the data proves it out. Over the last 25 years, we've had 10 meaningful dislocations in emerging markets. They've averaged about 20% over 5 months. That's the bad news. That's what we need to protect against today. The good news is extremely positive returns come after these dislocations, anywhere from 25, 30 to 50% over a period of time. So the challenge is preservation of capital on this side of the dislocation and being of a mindset to go attack that dislocation once it's occurred.
Mohamed, we'll talk more about that in the next segment, but I just want a final word from you on that. We've learned that painful lesson in emerging markets. You've learned it painfully, personally, at times as well. Do you think we've learned that lesson in developed markets? And is that the lesson ultimately you think that we're going to be taught in the coming years as the Fed pulls back?
I think we're going to learn it in developed markets, John, for 2 reasons. One is the significant change in the liquidity paradigm you just mentioned, and 2, the role of ETFs. On Monday, ETFs accounted for 40% of the volume, of the record volume. ETFs are a source of contagion because they bring all names together in the ETF. So I think that increasingly we're going to get that sense in the advanced markets. And you know what? For people who understand that dynamic, it is an incredible opportunity.
Robert, I wanted to come to you. Geopolitics, 2 broad mentions in the outlook. Ukraine, Russia, 1, China, US, 2. How are you thinking about those issues?
Yeah, I start with Ukraine and Russia. And it's definitely a worrying situation geopolitically, but from a portfolio perspective. And quite frankly, we're underweight to flat both of those assets. For us, we spent a lot of time thinking about this. And it seems like a coin toss in terms of whether there's going to be escalation and what that escalation may look like. And with Ukrainian bonds trading at like 80 cents on the dollar, it just doesn't make sense. It seemed very, very asymmetric relative to the potential outcomes. Our focus on China has been really as of late on the housing sector, the property sector, and kind of the intervention from the government top down, but also some of the challenges that the sector's had bottoms up. Unlike 21, where we thought that sector didn't really make a lot of sense due to that same asymmetry against you with par bonds. Now you got the same bonds trading at 20 cents, and you can start to see how the different players are acting. And it leads one to believe that it might be a more typical, rational, ad hoc restructuring process as opposed to the liquidation that many have feared.
When you say you've got a barbell approach, Robert, and on the one side you've got high conviction debt, and on the other side you've got opportunistic, special situations type stuff, where does China fit into all of that?
So for us, definitely it fits on the opportunistic side. So it's been a tactical underweight for quite some time going into this year. One, for the credit challenges that we talked about, the structural challenges that we talked about, but quite frankly, you just weren't paid that much for in absolute terms or relative terms. Today, that's different. The barbell is be anchored in conventional sources of yield that are always there, and for us, that's private credit that we've talked about in the past, and high conviction emerging market debt, and then the alternative sources of yield when they present themselves. Opportunistic, as you mentioned, which we would put China there. Argentina, which just announced a deal with the IMF this morning, we would put that there. Turkey, 2018, Turkey this year, opportunistically. So the idea is always have energy to draw from or yield to draw from, but then when the Chinas, the Turkeys, the Argentinas present themselves, you're in a position dynamically to move there. And I mean dynamically because the barbell is as much about a construct, it's about governance and the ability and willingness to be able to move.
Mohamed, some people would hear, let's go to the Chinese property sector, and the other person would run away. Why is that of interest to the firm?
I think what's of interest to the firm is the extent to which opportunities arise when regimes changes. John, it would have been unthinkable for you and I to have a discussion a year ago on whether is China investable. But I cannot tell you how often I've been asked that question in the last 5 or 6 months. Is China investable? When things like that happen, you need the 3 things that you've heard Robert refer to. 1 is great selectivity. 2 is granular analysis and construct. And 3 is dynamic allocations. This is what happens when you go through these massive regime changes. And that's just within China. We haven't talked about China-US. We haven't talked about Russia-Ukraine. I mean, there's a lot of stuff going on that make these 3 things really important as your driver of portfolio construct.
One thing you've talked about, Mohamed, and I can see that in the piece, are the countries, the nations, the sovereigns that have sat on the fence. They've tried to have one foot in the security sphere of the United States and another foot to get the economic exposure from China. And I think most people are asking not just if China is uninvestable, but just how sustainable a stance like that is for countries on the outside looking in. Are you questioning that too, Mohamed?
Yeah, because look at what has happened to poor Australia. For a long time, Australia had that dual option model, rely on the US for national security, parts of the Five Eyes intelligence system, and rely on China for economic prosperity, major exporter to China. And that dual option had a very low premium. Now, it's become a much more difficult thing. And Australia has suffered economically for making the choice of going with the US on various elements. So yes, that model is becoming harder to run. And believe me, countries don't want to choose because choice means fragmentation. And that's another headwind to the sorts of globalization that we've been used to.
It's this dispersion within sovereigns that I've picked up on in the piece that I think is really important, Robert. You guys like EM corporates over sovereigns, and you think there's greater dispersion between sovereigns. Robert, is China a big piece of that? Can you help me get a better understanding of it?
Yeah, I mean, I think the corporates versus the sovereigns, and for us, when we look at China as a sovereign, it's completely uninteresting just because of the lack of yield before you even get into the risk. But when we think about corporates versus sovereigns, post-COVID, there's been this big transfer of assets, and it's gone from sovereigns to corporates, whether that's in developed markets or to a lesser extent in developing markets. So we like corporates because they've been the benefactor of that. We also just like corporates because they tend to have less duration. and more spread cushion. And, back to the maturity of the asset class, 10 years ago, one wouldn't have thought that with the market drawing down, with interest rates, on the rise, that emerging markets high yield would outperform investment grade. And that shows you the maturation of the asset class and then starting to behave more like fixed income and less like risk on, risk off.
Can I finish on the conviction calls from both of you? And Robert, I'll give you the first opportunity, and Mohamed can get the last word on this as well. As you look ahead to the year ahead now, and as things are really starting to stack up, we've got an equity market in the US that's struggling on the screen again. Down 0.8 on a Russell, down 0.6 on the NASDAQ, down 0.6 on the S&P. Got a Federal Reserve that's talking about $1.5 trillion of balance sheet reduction. That's just the US Fed stuff. And EM, going through this with you both, it seems to be incredibly nuanced and very complex. Robert, if there is a strategic conviction call for you at the moment, what is it? What's the number one house view?
The number one house view is, the special sauce for us is that we have private credit, right? And private credit gives you the ability to get paid explicitly for illiquidity, and oftentimes 500 to 1,000 basis points over. Structure better credit, so we talked about credit risk before, with collateral, and take less risk, right? And that sounds strange. You take less risk and get higher yield. The difference is you're explicitly giving up the units of illiquidity. That, to me, is the highest conviction out here.
That's the EM call. Mohamed, we can dip a toe into what's happening in the market right now and finish with you. I remember going into the pandemic, you said, do not buy this dip. This equity market's getting hurt big time to start the year. Would you buy this one?
I would wait a little bit. I think you're going to get some really attractive opportunities. John, my listing of risks, respect liquidity risk first and foremost. If you are an international investor, respect currency risk, and then it is credit and equity risk. So I would focus on the liquidity elements of this sell-off and look to buy good names at overly depressed prices.